So we're seeing a lot more people chime in, a lot more articles about the cracks in the housing market. Things are starting to slow down. Maybe, the issues are starting to rear their head. We don't quite know yet, but there's one element that no one appears to be talking about, and it's actually kind of perplexing to me. And we'll talk about that in a second. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is April the 19th. Randy Patrick here, putting the realism back in real estate. Hope everyone is doing well and having a great time as spring springs, I guess you could say, across the country. This video is brought to you by our friends at Foreclosure.com. My affiliate link is gethousingdata.com, so gethousingdata.com. If you want to check out and find the distress listings in your neck of the woods, in your own backyard, in your neighborhood, go to gethousingdata.com. That's gethousingdata.com. Foreclosure.com is number one provider of distressed property listings across the U.S. All right, so again, feet on the street is where it's at. I can tell you that right now. Even from my perspective, I'm starting to see wholesale deals that are maybe staying on market a little longer and maybe have been out there. Then I'll see it a week later having some price reduction. So very interesting. Typically what we see is, when markets tend to shift or change or crack, as they say, we see it right now. Like I say, the feet in the street see it first, and then it permeates its way through retail sales, etc. So interesting perspective here. And the reason why I like this is Housing Bubble Blog's website. I like this website because he goes out and grabs snippets of information that gives us a litmus of what's going on across the country, which is cool. So this guy up in agent in Portland, basically was the first time in 2 years that one of his listings made it to Monday without any offers. This house listed at $500K, and after a Saturday open house, there were promises of at least 3 bids, including one for $40K over the asking price. Then Monday came, and there were none. And then Tuesday and Wednesday, oh my goodness, look what's happening here. An offer finally came in, but instead of being over the 10-15%, typically, right, bidding wars, it was right at $500,000, and the buyer took it. We didn't have the competing offers that would drive up the price. It's not crazy like it was. So we see that this rise in interest rates, this home buyer sentiment being as low as it's been in years, is starting to really have an effect now in the marketplace. So far, the greatest signs of the housing market slowing have shown up on the West Coast, where the budgets of aspiring buyers seem to have been broken by rising interest rates. That's happened in California. We're seeing some early indications that a growing share of home buyers, especially in expensive coastal markets, are getting priced out. What I'm expecting is for homes just starting to get fewer offers, and sellers will have to give up some of their power. Eventually, it'll filter down to prices, which is true. So there comes a point in time where we all have to realize that things are going to change. And as many economists and many analysts have said over the past few months, the market is not sustainable the way it's going right now. From Bloomberg, if you're wondering where the U.S. market might start to show its first cracks, keep an eye on Boise, Idaho. The pandemic work from anywhere revolution transformed it into one of the most hottest markets in the U.S., but home prices are leveling off. There you go. It's down a few points and some paces from summertime. The incredible pace of gains was never going to be sustainable, of course, and that's true of many pandemic-era miracle markets, even if you're ultimately bullish on their long-term prospects. The slowdown is hitting some western mountain towns now, but it's likely to catch up to Austin, Phoenix, Tampa, among others. For all their lifestyle appeal, relative value compared with California and New York. Some of these markets compress a decade's worth of home price appreciation to a couple of years, a development that became downright unhealthy. And that is exactly true. A lot of markets have taken time to grow over the past decade to get to that huge appreciation, whereas other markets have seen it kind of go up exponentially. Typically, the markets that have the highest or most, we'll say, highest angle or most exponential appreciation are the ones that are going to suffer the most when it goes the other way. It's always been historical. Interesting from the Chicago Tribune, some sellers don't realize interest rates will affect the price they will sell their property for and the time it will take to sell. Basically, a real estate agent up there says sellers need to understand the buyer who makes them an offer today may reduce their purchase price as interest rates increase. We have seen this happen in the last couple of weeks. Sellers need to understand the real estate market has shifted, and they may need to negotiate a little more than they did in the past, and certainly plan on it taking a lot longer to find a buyer. So, as I mentioned, various markets across the country are starting to see a slowdown. Now, is it a dramatic slowdown? Not particularly. Are we seeing massive price decreases, with appreciation? No, we're not, but we're seeing the first starting point of it. Okay, the slowdowns, longer days on market, not as many, I guess you could say, bidding wars and things like that. People are concerned. It's simple as that. And again, with the buyers' buying power being cut down dramatically with respect to the rise in interest rates, if you want to sell, you got to react to it. It's simple as that. There's no other way about it. So again, more housing markets crack. Continued demand slides to accelerating price cuts. So basically, the housing market was in a frenzy after record gains in the first quarter. Some home prices are likely to stall. Yeah, we've been running at a 20%. Like virtually every time we do a Case Shiller video, we see every month we're looking at double-digit price increases minimally on the top 20 metro markets. Every one of those have been double-digit, and obviously places like Phoenix up into 30% year over year. So it comes to a point where it's just not sustainable, and buyers are going to capitulate and say enough's enough. Redfin's latest observations, you can see a lot about Redfin stuff out there. Demand slips, pushing more sellers to drop asking prices. Here's the situation, though, is that we do see, still less inventory out there. So it's kind of that sort of really weird inflection point where we still have home price appreciation, we still have a decrease in listings and less inventory. But with these higher interest rates, it's kind of it's causing a slowdown and a pause with buyers to really, ascertain what's going to happen with themselves from a personal economic position and what's going to happen with the market in the future. Fewer people search for homes for sale on Google. The Redfin Home Buyer Demand Index has declined. Touring activity, has gone down 23 percentage points compared to this time last year. Mortgage purchase applications are down 6% from a year earlier, and obviously the mortgage interest rates have hit over 5%. So you see all these things are subtly overlaying over the real estate market, and at some point in time we'll start to see it make more of an impact with respect to what's happening in price points. And by the way, if you guys are not a subscriber to my channel and you appreciate the information I provide, if you could smash that subscribe button, I'd really appreciate that. So thank you. And also, if you are a subscriber, think you're a subscriber, could you please just subscribe once again, because I do lose subscribers on a daily, weekly, monthly basis. I always seem to ebb and flow at the same amount. So please check your subscription and that bell notification. I'd really appreciate that. Thank you. All right. So this is from a website called Mishtalk. All right. So obviously I'll certainly give him credit. You just go to mishtalk.com, and I think his name is Mike. I forget Mike's his first name, but Mike Shedlock, I believe. Anyway, he has some good information out there from the economy perspective. He had a little thing he put out on the housing. That's why I wanted to highlight it, because I kind of liked how it was written, and I liked his take on it. So obviously it's kind of a little thing here, not in a bubble, not inflation. Well, certainly we see exponential price rising on the right-hand side of the graph, so that's up to you to debate whether we're in a bubble or not. So this person put out some tweets. I don't know who this tweeter is, knowledge base, experience, accreditation, anything. I don't know. Just caught his eye. So I don't know if she's an analyst, housing analyst, who knows, right? But anyway, housing theory versus reality, where are home prices headed? This tweet caught his eye. It's in his article. It says, typical narrative is that the Fed hikes will materially slow the housing market. It may not all be different this time, but three factors will make the housing market more robust to higher rates this cycle. So what she's saying here is that, we've got three factors that really, almost like we'll be able to absorb the Fed interest rate hikes and nothing will happen in the housing market. All right. So take a look. Housing is a scarce asset with a demographic tailwind. Due to the underbuilding of the post-GFC era, there are simply not enough houses to go around. At the same time, millennials are reaching their prime household formation years. This contrasts with the overbuilding of the 2000s. So yes, obviously, prior to the last housing crisis, we had a huge build out by new home builders, building massive communities and the whole bit, and then doing things that they needed to do to sell and you sort of get people in there. So there was an oversupply. So everyone talks about what the housing market, they look at baseline supply and demand. Okay, we're not building as many houses as we used to back in the day for various reasons, timing, material, price point, the whole bit. Everything's gone up as far as cost concerned, labor shortage, the whole bit. So point here is that we don't have the overbuilding, which is going to keep supply down, so therefore no issues, right? Next point, robust balance sheets. Consumer balance sheets are historically robust. Relative to the over-leveraged consumers of the 2000s, a decade of balance sheet deleveraging and the forced savings of the COVID era put the consumer on a very different financial footing. Okay, I understand what she's saying here, but did COVID really make everybody save their money? Didn't a lot of people need to get stimulus and lost their jobs, etc.? So I don't know how many people's financial positions are better, due to COVID. I don't really know how I would be able to ascertain that. So, is my balance sheet better than it was before? Don't know. Okay. I mean, you have to take a look at your cash in the bank and the assets you own. Was the over leveraged consumer in the 2000s different than the over leveraged consumer here? Do we have a lot of people with credit card debt? We sure do. A lot of people with student loan debt? We sure do. Do we have a lot of people with high mortgage debt? We sure do. If prices are up, and we don't have subprime, but we have FHA-backed loans, and they have 3.5% down payment. So you could be just as over leveraged as we were back in the 2000s. So I don't know if I really buy that situation right now or what she's saying here. Again, lastly, Fed rate hikes have no effect on housing demand if the property is not financed but bought in cash. While the median new mortgage payment has doubled in the last year from roughly $1K to $2K per month, this has a much smaller impact on the investor class. All right, well, I guess, so yeah, but the investor class is buying with cash, but they're buying with cash via whatever funds they're involved with or whatever their money sources are with, okay? So there is some leveraging going on behind the scenes for the investor class. Overall, this mix of stronger consumer balance sheet, rising demand for housing, and rate-insensitive buyers implies that the Fed will need to hike more this cycle to have the same effect on economic activity. So ultimately, what's happening right now isn't enough to change the housing market, which, okay, it's a position, I suppose. I'm sure we can debate that. Again, I look at it going, money has to come from somewhere, whether you're a retail buyer, or whether you're an investor. And again, a lot of investors are buying cash because they have cash sources that eventually are going to put them into investor type loans. All right, simple as that. So this is what Mike of Mishtalk is saying. I agree with some of these ideas and strongly disagree with others. Some are mixed bags of pluses and minuses. So consumer balance sheets. The tweet chart shows mortgage debt payments as a percent of disposable income. That reflects the past, not the present. Housing affordability has plunged, and the Fed has barely started hiking. So true. We haven't seen, rates have gone from 3 to about 5. They're still projected to go higher. So there's more to be had from the Fed. The tweet did not really address overall balance sheets as the marginal buyer. Many people have been recently priced out. So there you go. Demographic wins. The wins are not all one direction. Millennials want to buy, but a huge wave of pending boomer deaths is on the horizon that will add to housing supply. So yeah, if you ever take a look at potential housing supply in the future, you have to take a look at the baby boomer market. And baby boomer market really, the time to sell was going to be about 2023, 2024, up for a good 5 or 6 years to the end of the decade. So the baby boomers is one of the largest generations that are out there. And, because of deaths and downsizing and stuff, there will be homes coming on the market due to that effect or that phenomena. Obviously, right now, to sell at a premium, you have to go buy. If you're downsizing, sell your McMansion at a premium, downsize, you're still going to be buying at a premium. Are you actually, using that money wisely? A lot of the boomers generation were, planned to use their home equity to fund some of their retirement lifestyles or purchases, etc. So not too sure if that's going to happen yet, but yeah, demographic will change for the boomers as next couple years comes on. All right. Demand slips, pushing more sellers to drop asking prices. Well, Redfin reports that price drops are climbing at its fastest pace since at least 2015. Another sign that demand is not meeting sellers' expectations. So yeah, you speak with your real estate agent. Your real estate agent says, "Well, just chase the market, do what we can because we can always drop prices." So You list your property, it sits there, you don't get the offers, you don't get the bids, you get some pullback. So what do? You reduce price point as much as you can, or in increments until you're at the point where you don't want to anymore, right? Again, you can always reduce. It's tough to raise prices. So there really is a limit to home buyer demand, even though the market over the past few years has made it seem endless, said the Redfin chief economist. The sharp increase in mortgage rates is pushing more home buyers out of the market, but it also appears to be discouraging some homeowners from selling. With demand and supply both slipping, the market isn't likely to flip from a seller's market to a buyer's market anytime soon. So Mike here is saying that that tweeter, Jessica, appears to have the spotlight on the lost sentence in the preceding paragraph. He would emphasize the first sentence, which basically says there really is a limit to home buyer demand. There comes a point in time when people go, enough's enough, and I'm just not going to pay it. Simple as that. And then it's almost like it's a movement that starts, and then things do start to change slowly behind the scenes, and it picks up steam. I see that happening as well too. So anyway, then downtrends start, then accelerate. Okay, so we see it slow down, we see things kind of plateau, and then we see it pick up and push farther downward. In every cycle, prices remain sticky for a while. This cycle wasn't certainly not as speculative as the last, and the downturn will likely not be as steep. So he's basically saying, and this is as an age-old, I guess you could say, argument to like pro housing market, not for the housing bubble or the housing crash. It's about speculation. And so this is kind of the one component that I actually love to debate, because, when you think of speculation, you think of investors and you think of them rolling the dice, and it's other people's money and they're not emotionally tied to the property. They don't care what happens. So if I make money, great. If I lose money, oh well, let it go to foreclosure, whatever, write it off, the whole bit. Okay, well, I'm going to say that's not quite the case here, because for the past few years, up until now, the market cracking, we have had a good couple years of low inventory with hot markets, the double-digit home price appreciation, and virtually every real estate agent will tell you, if they've got a listing, they're receiving multiple offers or multiple contracts on that property. All right, and some of these offers have escalation clauses, which basically is a piece of paper that the buyer signs saying, hey, if you have a higher than offer than ours, we'll match that offer plus 5K up to a certain point. So now, and I've been in situations where my sellers have gotten multiple offers and multiple escalation addendums as well too. So what do you do there? But that's the whole point. So see, speculation tends to be reserved for the investor people, the investor mindset, the investor home buyers out there, which I get, but I think this has been blended now with respect to the amount of bidding wars that people have gotten into over the past. What we've heard reported over the past couple of years, home buyers are actually have become, like retail home buyers, owner occupants have become speculators in this case, because if you're buying a property for a list price and you're adding 30-40 grand, okay, you're rolling the dice that when you get your loan and that appraiser goes out there and appraises the property, you're rolling the dice that appraiser is going to go, yeah, it will appraise for 40K more than what the list price was. All right. So, these things are actually happening. So that's why I kind of go, okay, not as speculative as the last. The downturn won't be as steep. Well, you know what? I don't know about that, because I think we're just as speculative, if not more speculative. And the segment that is speculating isn't being accounted for, which is the retail buyer side. All right. So, and I can tell you, if you start looking at articles and websites, whatever, there is buyer remorse. We have shitty buyer sentiment right now, lowest in a long time. But now we're having buyer remorse. People are going, I don't feel good about overbuying that property. Buyers realize that if the market does subtly change, they're now underwater, or the cost to resell minus closing costs, commissions, prorations, whatever, now puts you below where you bought it from, or you're in a lost position, okay, et cetera, with your money. So especially if you have if you took an FHA loan, right, at 3.5% down, the typical 5 to 6% on commissions, you're negative already with respect to your 3.5% down. You see, so this is where we did speculate, and it wasn't the investors that speculated that caused a lot of the problems. It was the retail home buyers. That's a big difference with respect to what happened in the last housing crisis. So there could still be some problems, all right? Now, here's my point. I said there's something they're not even accounting for right now. Where are the foreclosures? Okay, are they forgotten? Well, when I look at all the housing news and all the things out there, nobody talks about foreclosures. Today, I did see a couple articles on forbearance, saying forbearance dropped to an all-time low. And why did forbearance drop to an all-time low? It's because people are exiting their forbearance programs because their forbearance programs are over from a time period perspective, right? When you exit a forbearance program, it does not mean that you're magically solvent, that you're now making your monthly mortgage payments and everything's been rigged up and you're ready to go. It just says that you've exited the forbearance program. You exit the program, and then now you have to connect with your lender, and you have to talk to the loss mitigation section, and you have to work through whatever plans they can offer based on your income and availability and all that type of stuff. And if it doesn't work, it doesn't work, and you're going to drop out of that and fall into the foreclosure bucket. So you see, we're just not talking about these things because we're just not talking about them. It's not part of the narrative, all right? The narrative stopped talking about the distress level. So that's the whole thing. So really, as I said, what's our thing now? I mean, there's no more housing bubble. It's called we're in an affordability crisis. So housing affordability has now replaced the word housing bubble concept, right? And again, no one's talked about this. So we've gone on record. I've gone on record saying there's a ton of these out there. It will manifest. We're into 2022 now. We're in the second quarter. We're seeing a pickup in all foreclosure activity, slowly churning through. And as the time goes on, it will start to make an impact or give us choice out there in the marketplace. We're approaching the spring selling season right now, and this is where we don't have enough foreclosures and enough of the distress ready to make an impact on the market to affect the spring selling season. So we're probably going to see home price appreciation still increase. We're probably going to see a few bidding wars and stuff as we move it from April into May and June. But once the selling season is over, we'll have more foreclosures going through the system. Now we'll start to see a slowdown with respect to sales, and maybe if we have a continual increase in mortgage interest rates, that will affect the market on a much larger scale, and we'll start to see some real changes here. So that's what I wanted to point out. So that was my statement. First statement, of course, in the video was there's something they're not talking about that could affect the marketplace here, and they just don't talk about it. So I don't know why. I guess it's not a cool thing to talk about it, not part of the narrative. But you know what? This is, they're there. They're there. They're tough to see, tough to find. No one talks about it. Ambiguous numbers. We just don't. It's almost like it's the word you don't speak of, right? Who's not spoken about or whatever, right? So that's what's happening right now with the foreclosure stuff. So not here yet, but it's available. So, and as I said, they say, so none of this will make an impact on the housing market. None of the forbearance people, none of the foreclosure people, none of the distressed people will make an impact in the housing market. That can't be so, all right? It's going to make some impact because no one is considering the impact that it could make at this point in time. Because again, we weren't talking about market slowing down until it happened, because interest rates forced it to do some slowdown, and now we're seeing the cracks, right? So we're obviously not going to talk about foreclosures until we start seeing them, and then it'll be a topic of discussion. So that's where we're at with that, I believe. Okay, so keep in mind that, again, they're not here to make an impact yet. They're coming. Now, as I talk about the stats, I mean, obviously lots of forbearance, underrepresented, a lot of people who are delinquent, not in any loss mitigation program with their lender. A lot of people who are in loss mitigation programs aren't paying their lenders, so they're going to fall out of those. And, as I said, for the past couple of years, I've heard the estimates of 3 million to 10 plus million foreclosures, somewhere in that realm. Where are we going to be? I always say let's go in the middle, right? Who knows? But, again, it's not 500,000. It's not 50 million. It's that 3 to 10, 3 to 11 million, somewhere in that range. We've heard people talk about it, and then funny enough, we don't hear any more talk about it. Simple as that. So you know what I say to that. If they don't mention it, they don't want you to know about it, they don't want you to participate in this market and get your hands on better price deals, all right? As I said, there's two housing markets in play right now. Our retail market, which is mainstream media narrative, and the shadow inventory, which is distress, pre-foreclosures, probates, tax deeds, all those stuff behind the scenes, all right? That's where the deals are. That's where the opportunity is. And speaking of that, I've got my distressed deal architect thing. I'm signing people up right now. I'm loading stuff into the system for training. In a couple of weeks, we're going to start live training once a week on these topics: foreclosures, auctions, and REOs, pre-foreclosures and short sales, tax deeds, probate estate deals subject to the mortgage. Very interesting, a great opportunity coming up soon. Vacant land's valuable, right? Why? Because you can do stuff with it. Obviously, build to rent, build to flip as an alternative for income. Cash flow, or just to have a house, or just to cash out. And the Airbnb opportunity, more and more things are happening with Airbnb now. Short-term rentals. This is the main stuff we're going to cover, plus a lot more things to support this. So please, I know there are people that have emailed me over the past few days. I need to get back to you. I will do so over the next couple of days. There are people who are signing up right now, so I'm trying to get everybody in now so I can start doing my prelim training next week and we can start moving. So please reach out to me and we'll get you rigged up on this. All right. So that's the scoop. Why do we do this? Well, again, because you can possibly get deals like this. They're out there. You just have to find them. All right. This would be a shame. This would be a total shame if this home went back to the lender and the homeowner had the foreclosure on their record and they had a judgment against them. We were able to stop the foreclosure sale, get a great deal with the lender, build some equity in for the purchaser here, solve the problem for the homeowner, and a big big hedge fund didn't get to buy this. All right, it went to a smaller investor buyer who is probably going to rent it out and provide shelter for somebody. So this is the point, though, is that these deals are out there. You just have to find them, and part of my stuff is showing you how to do that. All right. So if you guys want to engage the market, please send me an email. That's my email right there, randy@luxuryshortsales.com. And once again, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe, help my channel grow, and we look forward to speaking with you in a couple days. Take care.